Good morning, good afternoon, good evening, depending on where you're watching from. Welcome back to the Musari Show. I'm really excited to introduce today's guest, but before we get into it, if you're checking in from YouTube, please be sure to hit the like and subscribe button, as well as drop a comment. And if you're listening from Spotify, please be sure to drop a five-star rating as well as a comment. I'm really excited to introduce our guest for today. So they have developed a really exciting platform that is going to revolutionize Wall Street, in my view, which is called Delphex. And this company is a really fast-growing startup that does provide services to the banking sector, in particular corporate bonds, to help mitigate the downgrade risk. And obviously, we are in quite a dynamic. That I think that's a very nice and generous word. We're in a very dynamic market at the moment, and I believe that the relevance is going to increase over time. So, ladies and gentlemen, please do join me in welcoming Mr. Patrick Wood. Patrick, it's really great to have you today.
Great being here. Thank you for having me.
Oh, that's awesome. So in chatting with you, I think one thing we have in common is, identifying the gaps that we see in the traditional banking sector.
Mhm.
So tell us a bit about, your journey of how you got to where you are today, because,
Yeah, sure. Yeah, so Delphex is a company that was launched as a public company back in 2018, and as most startups go, the original management team blew up the company. They had a product that was completely useless, and as a shareholder and somebody who was definitely had a vested interest in the success of the company and its other shareholders, I came in very reluctantly as the CEO of the company, and 4.5 years later, we've been able to not only turn the ship around and clean the deck, but also develop a product which we're very, very excited about. And that is a product called a credit rating security, which allows mostly insurance companies
yeah,
to offset the losses that they incur when downgrades happen in their corporate bonds.
yeah.
So we, like I said, that's the overall picture of Delphex. There's a lot more, as you know. I'm sure you can imagine. I mean, any startup has a lot of fits and starts. We've been telling our shareholders really for 3 years, we're going to launch any day. We're going to launch any day.
Yeah.
We've really tried to find the right product, and in doing so, we've been able to finally get there by really listening to what Wall Street needs, because I think personally, our experience with Wall Street is that it's been asleep at the wheel for the last long time, and innovation, specifically to credit markets, which is our niche, it's been just gone. It doesn't exist anymore. So we're really, like I said, it created a gap for us as a really small company with very experienced, talented people to come in and find a need, and find a solution to that need. And that's what we've got with our credit rating securities.
That's a very interesting observation about a market that's perceived to be like the global financial capital. So in your case, obviously with in the whole startup community, the lean startup method is highly adopted, where it's a very cost efficient manner of like testing a minimal viable product. So
Mhm.
how has the journey been of like actually developing the product versus the first concept? For
Sure.
example, to answer your question, um, how did the first early version of the product look, let's say 4.5 years ago, and how was the journey of evolving that? I
Sure.
imagine you did test the concept in the market.
Yeah, so that's actually a terrific question, and that is actually gets to the root of why our company needed somebody like myself to step in. The original management team, they had a product that was so convoluted, so complex. There was absolutely no acceptance for it on Wall Street or anywhere for that matter.
Mm.
And so unfortunately, the real problem there was they didn't really ask people what they wanted.
Yeah.
They really thought in their own minds, and this is what happens usually with people who are stubborn and don't really have a track record of doing this, and that is that they don't really find the need and build something to solve that need. So what we did when we first came in, not only did we bring on the top advisors that we could possibly find on the street, people who had done great, successful, kind of management of, CDOs, CLOs, CDS, that structured product business over the years. But
Yeah.
we also really went to the investment community, mostly the insurance community, and we said, guys, what is your pain point?
Yeah.
Where are you guys most suffering in your corporate bond portfolios? And so they told us, look, when I get downgrades in my bonds, because they're largely buy and hold guys. They said, yeah, when we get downgrades in our bonds, we really, we get punished because, the NAIC slaps us with new capital charges.
Yeah.
Not only that, generally our internal mechanisms and control measures have us putting aside, 4x in some cases, that extra reserve capital. So it's okay if you're flush with capital, but if you're not, you want to deploy that capital. You don't want it sitting there doing nothing for you. And
That's
so,
right.
and so, like I said, these guys are buy and hold investors. When they have a triple B bond, that they're paying, let's say 1.52 on, and that bond gets downgraded to double B plus, that capital charge increases to 3.15. That's a 1.63 difference.
Yeah.
Those guys, that's a lot of capital to put aside.
That's
now,
right.
they can't sell that bond, because if they sell that bond, they're taking a loss on it.
They're going to take a loss.
Yeah, they want to wait till par, and they want to have high fives at the end of the day and have a win. So what our product does essentially is it just gives them coverage so that when that bond gets downgraded, or if it does, the hedge fund on the other side, who loves this product because hedge funds love risk and reward, and we partnered with now 3 of them. The hedge funds love this because it's a new business line for them. And so we sit in the middle. We're the issuer. We act as placement agent generally through our broker dealer to essentially, put this all together for both sides. And out of that, obviously, we get a fee and all the rest of it. So like I said, that's the business. But to that end, it took us listening to what people needed. Which, by the way, Wall Street wasn't doing. And even when we rolled this out, our first strategy was like, hey, let's bring in another, BD, somebody like a large primary dealer, or, somebody who could, run this through their relationships. Can't tell you all the time we spoke to these guys. And it's mostly, I hate to say it, it's older aged, guys sitting at the desk who have a few more bonus cycles to go. They truly don't want to mess anything up. They don't want to take on any risks. That's why, like I said, it created an avenue for us to come in. But all these guys told us, we don't have the bandwidth. And then we said, okay, let's build our own sales team and get this done. And we did. As a small little tiny New York company, which is what we are, we've been able to execute something much greater than we thought we would be able to do ourselves. But I think that's, a testament to the product and the product strength, and clearly, our salespeople as well. So
you actually highlighted a mistake that is quite common in the startup community. You do still find pockets of like founders who have this assumption that, their idea, whether validated or not, is going to work without understanding the pain points of the target user that they're going for. So that's something quite interesting that you touched on right there.
Yeah, it is. Unfortunately, like I said, the first iteration of this company was a group like that. So we had to come in and really, like I said, clean the deck. But there was some, kind of semblance of some IP there that we thought, we could leverage a little bit, and we did. So we took like maybe 5% of what was actually there. And we were able to kind of, move it along, which by the way, once again, it's another testament to the fact that, there's not really any product innovation or new things happening on the street, because we were able to design essentially from scratch a brand new product. If you look at some of the larger banks and dealers out there, I mean, they've got, 50, 100 people on staff, like a full group of analysts and others and quants. Why haven't they designed this? We don't care. It's wonderful for us because now we're the OG, we're the leader in the space. And to that end, we have 3 hedge funds, 2 insurance companies at the table right now negotiating terms for about $4 billion in notional coverage for corporate bonds that these guys have. And certainly this is like, the ark. I mean, as soon as you have one set of animals on the ark, they all want to pile in. And so we think that's definitely going to happen right after we launch in the next couple of weeks or so. So
that's insightful. And speaking of pain points, the first thing that came to mind is like the current situation, right? Because I admit I don't follow the bond market that closely,
Sure.
I do follow, the economic fundamentals, like how inflation is looking, the public debt, which is quite concerning. I do kind of follow the stock market, but I'm not one of those people who just reacts emotionally to stock market movements. I pay attention to the trends of the actual earnings of the companies because short term it reacts almost emotionally, but long term it responds to fundamentals. So with the whole uncertainty around the tariff policies, how have things been transpiring on the ground in
So,
the market?
so I would have thought it would be a lot worse, to be quite frank, because equities are shaky. Generally, when you have uncertainty, in the world, that's generally not a good thing for markets.
Yeah.
And I think there's a couple of reasons for that. I think there's also been a complacency, not just with Wall Street, but I think there's been a complacency with bond holders
Mm-hmm.
to some degree. The bond market really hasn't had too many shocks over the last, oh gosh, how long has it been, man? I'm dating myself now. I mean, I think the last one that I remember that was really big was in '08.
Yeah.
And no one's ever going to forget that one. but,
Oh, yeah.
but that being said, we're pretty much, way overdue for a big shock to the bond market. I mean, COVID was. I mean, the pandemic was definitely, it really kicked the heck out of the bond market, but it was very short term, which was good. But yeah, I'm surprised that the bond market hasn't reacted more negatively, and I don't think that's because maybe it shouldn't. I think it's more because maybe bond managers have a level of comfort, perhaps complacency, that they're comfortable with and that they're used to, and that's kind of a dangerous situation because if people aren't actually actively protecting against risk, from a straight risk management perspective, that's a really, like I said, it's shaky waters to kind of sail in, and so I think there's a couple of things that, like I said, the bond market should be more kind of pricing this in. I don't think it has yet.
Wow.
Yeah, but listen, I mean, who knows what the outcome of these things will be, as far as the economic fundamentals and all the political stuff and whatnot. But end of the day, any uncertainty, any change, generally should kind of cause a little bit more of a, cautious approach. And I just haven't seen that yet. But for the insurance companies who are buying our product, though, man, they get kudos because those guys are actually they're thinking smart. And they're thinking, okay, this is a risk protection. So basically, it's a risk management measure or solution that sure, it eats a little bit of my yield to maturity, but helps me ride out the next 12 months very comfortably. So
very, very interesting input. I wish a lot of people heard that because the general tendency of human nature is to react to headlines and react to stock market. People think everything's going chaos, but some parts of the market are quite stable. Because it also made me remember, I think it was like 2-3 years ago, when some of the banks were going through troubling times, like Silicon Valley Bank, and one of the issues was the large portfolio that had unrealized losses that scared a lot of consumers, a lot of like clients, and there was a bank run. So how did you guys like navigate through that process? Because
yeah, so that's another great question. And to that end, when all that happened, once again, there wasn't a big sell-off in the bond market. You would think there would be. And I know for a fact the FDIC, who are the guys that are protecting the banks when things go bad, and in general, but they were very active. Some of the folks we knew there in New York at the time, they were like, oh my gosh, guys, this is heavy. I don't know how that got solved, man, but it's not as if those unrealized losses and that real garbage paper, it's not as if it's gone away.
that's right.
You know what I mean? Like it's still there. And so, okay, so what happens next then? When does that ugly, that ugly kind of bond, or, when does that bad balance sheet reveal itself? And sure, they bought a lot of time, and time is the healer of all wounds in some cases, but I don't know. It's there's still areas that are very concerning, and CRE is one of them. And I think those bonds, particularly those Silicon Valley bonds, et cetera. I mean, they were dicey, very dicey at the time. So And if they're doing it, then there's probably somebody else doing it. But who knows, man? I mean, the regulators are pretty good these days with that stuff.
Yeah.
But once again, where did all that bad paper go? So we'll see. Like I said, but yeah, no. So to answer your question, there really wasn't an impact in the bond market that was super negative at the time. But it did lead us to as well concur that hey, having downgrade protection is a smart thing to do, especially if you like the underlying issuer. So, for example, and I hate to pick on Boeing, but Boeing's they've had a tough time over the last year and a half, 2 years, and
I
so
read about that.
yeah. So I mean, their bonds got pretty spanked. I mean, they were really down, and I think they went to triple B minus, which is one notch above junk paper, which is wild for such a a strong American company. But what happened is anybody who had those Boeing bonds as an insurance company, and there's billions and billions of Boeing paper out there. They were holding those bonds, and they're not going to sell Boeing because long term, 5-7 years, if that's when the bond matures, they think Boeing's still going to be around.
Yeah.
But to hold that bond, their capital charges have doubled in a lot of cases, and now they're holding a bond that might be generating a little bit more yield than treasuries, but that's not really a great place to be, and they don't want to sell it because it's at a loss. Whereas, if they think that the next 12 months could be dicey for Boeing, or if they thought that 12 months ago, they would have been in fine shape right now had they bought our product and put on the protection. So,
well, that's awesome. And I must admit that on my side, I pay more attention to, to federal bonds, like government bonds, and obviously in the last couple of years, with the whole geopolitical situation, we've seen different countries take a certain stance on, government bonds from the U.S. Has Delphex ever considered or done some sort of gap analysis that exists on sort of like sovereign bonds in the sovereign bond market? I know that's a tricky one, and I know it's got its regulatory nuances that you're more aware of than I am.
So we really haven't explored that yet. But the good thing about our solution, our credit rating securities, is they're very malleable in the sense that, at some point we can move into municipals, we can move into government and sovereign bonds. The versatility in something like this, especially in this structure that we've got, which is basically runs off the 4A2 program in the US, a program specifically designed for private placements for qualified institutional buyers. It's very malleable. And so the other place that we've had a lot of people ask us, hey, can we do this in our credit linked notes portfolio? Or can we do this in our private bond portfolio? Because the private bond market is pretty massive as well.
Yeah.
And if you could put on a hedge there, I mean, that would be massive. And to that end, that wouldn't be necessarily focused on capital charges. It would be more focused on spread changes and duration risk, which we also have a version of our product which covers that. So we've already built that other product, which I think would be, it opens the door to a lot more people looking to offset risk in a downgrade. So
yeah.
Not just the insurance companies. Yeah.
Yeah, I think that'll have massive potential, because, in my mind, it's like when I look at, the international bond market, well, when I say international, I mean as in, the different treasuries in different countries that hold onto like U.S. government bonds. Obviously, there is the geopolitical tension side of things, but there is also the fundamentals concern around it, right? Because I mean, you look at the United States, right?
Mm-hmm.
Obviously, there is a bit of printing that does go on, and the numbers of when I say numbers, as in the interest bill keeps on going up quite a bit. However, there are a lot of fundamental reasons why you'd want to be concerned about that, right? Because over the last couple of years, the debt's really been piling up. It's very clear that, even to this day, I would say that, the plan to be in a situation where the government collects enough revenue to pay the bills without having to print additional money.
Sure.
It does create valid concerns around holding bonds in the US dollar, right? So it would be great if there could be like a solution for, that kind of market for the other countries that do hold on to that, because there's been a lot of dumping that's happened.
Yeah.
While there's tension, there are valid reasons. Because sometimes when I talk to people, I tell them, like, listen, that's the same thing as you holding on to a bond of a company with negative EBITDA, negative EBIT, negative earnings, but they guarantee they're never going to default because they're always going to print enough money to pay.
Yeah. Exactly. That's a pretty that's a tough thing to opine on, because I've been wrong about it more than ever. And I'll tell you, I mean, it's just, yeah, if you take in the opposite of what I was kind of saying at the time, that is that government debt is bad and having deficits is out of control and it's not sustainable. Wow. I've been wrong for the last 30 years.
Wow. I would love to hear your perspective, because I mean, in my side, I mean, obviously, 30 years ago, I was in primary school. Sure. Last time the books were balanced, it was like 25 years ago under Clinton's days. And since then, it's just been in deficit. I'd like to hear a different perspective. I'm so curious to hear it.
Well, okay. So like it really flows in with debt. And, is debt a good or bad thing? The quality of life in America with debt has only improved over the years. It hasn't gotten worse. So there's more choice. There's more, there's more success in the country than there's ever been. And so I think to that end, they maybe it's kicking the can down the road. Maybe at some point, this kind of stuff catches up with folks. But at the same time, the current deficit, I mean, it's like what, $33 trillion and growing, like you said, all the time. I was in Dallas the other day for my daughter. She was in a cheer. Well, she's a cheer competitor and an expert in it. And anyway, we were looking and just at the buildings in Dallas, and of course they have this big billboard there, and it's the national debt. And I was like, oh my gosh. I mean, this thing's going up like 100 million every couple of minutes. It's awful to see. And that's not sustainable. At some point, that has a huge impact on the dollar.
That's right.
And that will devalue the dollar in a big way. Now, has every other country also been printing money? Like nobody's business? Like, I mean, I hate to pick on them, but think about Canada. I mean, what those people have done, what that country has done. I mean, you're talking, debt to GDP, which is enormous. And I mean, it's just, at some point, Canada is going to have to, look at a 30-cent dollar, maybe. I think it's 70 cents now. But I mean, you can't sustain that kind of model because the country doesn't have the growth, certainly doesn't have the innovation, and it just doesn't have the number of people to pay that debt off. I think America, it does have the ability to do that, as long as the economic growth, as long as the new policies, what they're designed to do, or what the politicians say that they're designed to do. If they work, if they work, then that's great, man. That then that would be a huge plus. But I think at some point there could be a product that would fit that bill. I know the Europeans are the greatest designers of structured products. Those folks over there have been really kind of doing a great job over the years. Supporting the structured product market, especially with FX. That's their real niche market. But to design a bond market product, which can arb or protect against certain things, it's at some point I think there's a room for that. Maybe a deficit product, something along those lines. But that being said, I think the deficit, if the economy and if spending come down, so if economy grows, spending comes down, you do end up with a win. There is a balance at some point, but to see it continue to grow at this pace, like, the Dallas billboard had it, it's like, man, that's too much. It's just any reasonable person would say, gosh, this is too much. But at the same time, I would have thought it was too much, $20 trillion ago. You know what I mean? And so, I just, at the same time, it's like, okay, when does this balance? How does it balance? But then, can it put on another 10, 20 trillion and the same quality of life, or maybe a better quality of life is there? I don't know.
I like to hear different schools of thought around this thing because, on one hand, you have like someone like Ray Dalio, who's quite credible. I think he tends to be politically unbiased in his stance, right?
Mhm.
Because on one hand, he's like, okay, if the debt keeps on growing at this pace, who's going to be the bondholder, right? Which bondholder is going to have appetite for the additional debt to continue to grow?
Sure. Yeah. Yeah.
That's
Yeah.
a valid concern. I'm not sure if there's an answer for that, right? And obviously, we do see the efforts around cutting spending costs. It's coming with a lot of noise attached to it, but
Mm.
I do think it's a necessary exercise. However, I'm not too sure how the reshaping of the country is gonna play out because it kind of hints towards cutting a lot of benefits. But I don't want to go into that because of a whole political debate. And
Mhm.
then on the other hand,
Sure.
you have a more optimistic school of thought. The public person I've heard share this optimistic view is Jeff Bezos. And there is someone in the energy sector, right? I think that person was not influenced by Jeff Bezos directly. This person works in a massive midstream pipeline company,
Mhm.
and they're very in close touch with the demand that comes with the whole booming data center industry, right? So this week here, Jensen Huang, the CEO of NVIDIA, made mention that the AI evolution and processing is going to be capped at the energy supply in the U.S. because the
Mm.
data center becomes a huge energy demand. So the most optimistic view I've ever heard came from a person in the energy sector. I actually want to ping this person. It's a close relative. I won't say who it is.
Yeah.
I want
Yeah.
to
That's
ping
okay.
this person and ask them for the updated view, and maybe I'll do that over time. So
Mhm.
this person told me that, in the 90s, one thing that contributed to the balancing of the books was the booming of the tech industry, like the Microsofts and them. And they feel like the energy sector will boom as a result of the tech and AI sector boom that could also play favorably in the fiscal health of the country. Not that, the fiscal responsibility is increasing significantly. So
Mhm.
it's
Mhm.
interesting to hear both of these views. I wish the most optimistic one would play out, but it's quite interesting
Yeah.
to see what's going to transpire in the next couple of years.
Yeah. So, I mean, it's- I mean, look, there's so many changes, right?
Mhm.
Not just political. I mean, political changes all the time, but just even demographics. Like for example, Social Security is as an example. People started living longer.
Yeah,
That's why there's a deficit in Social Security.
yeah.
Um, and so who would have predicted that? You know what I mean? You just wouldn't have predicted that people
Mhm.
would keep living longer and longer and longer. I mean, I think the mortality rate for men 20 years ago was something like 70 or 72. I mean, today I think it's like 78 or 80.
The
I mean,
president's beyond the
I
mortality rate.
mean, I mean, we're living forever now. I mean, it's ridiculous, but it's a drain on Social Security, right? And
Mhm.
so that demographic shift, nobody could really plan that out. So there's so much evolution constantly in the economy and certainly in the world, but I just I think there's always going to be times where both micro, specific to a company, or in general, like a macro view, where the economy suffers. I think you're always going to have problems, and so that's why we really focused on like, hey, how do we help people protect against those problems when they happen, but then still have faith in the company or the economy that it's going
Mhm.
to do well and come out of this. And so once again, we built a product that's meant for those types of situations and those types of times. So,
Yeah. No, it's really, really, really going to be
so
interesting
I'm
to see
sorry I
what.
shifted the conversation completely from something completely broad to my product again, but
Yeah.
selfishly I want to promote my product as much as I can.
No, that's awesome. That's awesome because while you're at it, you also like shared your view.
Yeah.
Yeah, I mean, it's really going to be interesting to see how things play out in the next decade. I must say that fiscal responsibility is my concern because every other fundamental in the economy is going to be impacted by that, and so I'm sure that your team does have a sort of an outlook for the future because obviously you do provide a very vital solution to the corporate bond market, and I'm pretty sure you do have an outlook for the next couple of years. So how do you see things playing out in the bond market, given the direction of the
Sure.
policy? I know it's kind of a hard guess given the uncertainties of what policies are going to really be in play.
Yeah. So I think and we're agnostic to politics. We stay out of that discussion completely, both at the dinner table as much as possible and in the office.
Congratulations.
Yeah, so I mean, we do think that the economy in the U.S. is going to do very well. We think that these policies will have a very, very strong positive impact on the U.S. and that's that's where we focus. Although all of our companies, the companies in the bond market are multinationals for the most part, and so tariffs do hurt these guys to some point.
Yeah.
And I think the next 12 months could be really challenging on bottom lines. Because inevitably costs will go up as the country is kind of retooled and reshaped to manufacture these things here. But certainly the commitment is coming in from every company in the world right now. Like, hey, we're going to build factories. We're going to build stuff in America. So yeah. I think that no matter what aisle of the spectrum you're on, if you're on the right or the left, you like to hear stuff like that. And yeah, so from an economical perspective, I think that's a big thing. Because if you have, building and you reshift the landscape from global to, more national, that will be a huge thing for America. So I think America in general will do really well, but there's going to be companies, certainly short term, that are going to be struggling. Even looking at Nike yesterday, Nike put out some results and they're like, yeah, man, we're getting killed with these tariffs. Like, and it's just started. Like, this stuff has just started, but they're like, yeah, it's going to suck. It's going to be really, really hard for the next little while. So what does that do to Nike's bonds short term? I mean, no one's going to sell Nike. I mean, they're going to be around forever. But they really are the greatest, running shoe manufacturer, basketball shoe on the planet. And I mean, they're just such a huge brand. But short term, you know what? Analysts and certainly, the ranking or grading agencies are going to look at Nike's bottom line and their top. They're going to say, okay, this is not sustainable. This doesn't add up. Nike's carrying some debt, which I don't know if they are or they're not, but if they are, which I imagine they would, that debt's going to get downgraded. It will get punished. So if you're a manager, you own Nike bonds, like say $500 million in Nike bonds, you don't want to sell the company. You're happy owning Nike because it's going to do well long term. But the next 12 months, it could feel some pain. So that's where we fit in, is in something like that. Because our product, once again, is designed for short-term pain. It's not for the guy who wants to sell the company. It's for the guy who wants to hold the company and really, just ride out the storm in capital charges. So, yeah,
that's a very smart selling strategy, I must say, and the subtle one.
I hope so. Yeah, I mean,
I was sort of going to counter that because there have been cases where some companies are just of really national importance to the U.S. economy, given how they single-handedly contribute to U.S.'s competitive advantage geopolitically. Sure. And there have been cases where some CEOs have actually approached whoever the sitting president is and said, listen, if we don't have an exemption on this tariff and that tariff, that could actually impact our country this and that way. And there have been cases where exceptions have been opened. That is a possibility. I'm not trying to say that your solution won't have a part to play, but
we hope it will. And I mean, at the end of the day, man, I mean, are tariffs really going to be there forever, or is it a bargaining chip?
It's a bargaining chip. It's a bargaining chip.
I don't know. I mean, it seems to me like it's more of a bargaining chip than anything else.
That's right.
So, I mean, that's my guess. But I mean, what do I know? I mean, I'm so far from that.
I think long term, because there is the manufacturing play, but there's also like the trade play from what I see. Because, unfortunately, I'm saying this as a non-American who wants America to succeed. The same way I would like, my own country to succeed.
Sure.
Because on the other hand, a lot of these countries do charge quite hefty tariffs in the U.S. And, as a non-American who's been around the world, I've noticed that a lot of really great U.S. products don't make it outside the country. And from a very young age, I used to wonder why, why don't we eat cereals?
I'm glad you noticed that because I had the same experience growing up in Canada. We were dying for USDA steak. We never got it. We got this terrible Canadian steak. And it was it was not good. I mean, it really wasn't good. It was bad steak. I don't care how many farmers I have set up in Canada, but at the same time, USDA was the holy grail of steak. and you couldn't get it up there.
Yeah, even in my childhood, when I moved back to my country, I'm like, why are we eating this kind of cornflakes, but meanwhile, American cornflakes better? Why are we eating this and not that? But then, as I understood economics better, I realized a lot of countries were tariffing America, and a lot of products weren't making it there. So this could really play out, good in the long term in terms of, a lot of U.S. producers having their products, make it to certain markets and being more of a reciprocal trade relationship with different countries.
Yeah, it's evening the playing field, man. It's saying let's play fair, man. We'll play fair with you. You play fair with us. I hope that's what the current administration is looking for.
Yes, it does sound like it. Because I remember in the first administration, I was actually working in oil and gas in the organization that I'm in, and I started paying attention to, the global players in terms of driving supply and demand for oil and for natural gas. And, as a result of certain moves made, it did translate to America becoming a net exporter of oil for the first time in like 75 years. So
yeah, that was cool, man. That was really cool.
These apparently erratic decisions translate to something that's quite solid for the economy.
Yeah. I mean, I won't forget that when I saw those numbers, and I thought, oh man, that is so cool. Good for him for doing that. I thought that was awesome, actually. Yeah. So yeah,
absolutely. No, otherwise, thanks so much for having us, Patrick. So maybe before we wrap up, maybe the last words you'd like to share with any corporation that would like to have their downgrade risk mitigated, and also where they can find info on Delphex.
Yeah, so you can find us at our website, which is, and it's a really stupid name of our company, but once again, it's something we just inherited. We've already addressed that, but I'll address it with your audience. So our company is called Delphex Capital Markets, but you can find us at delphx.com. I'll say it again, delphx.com. You can find out a whole bunch of stuff with us there and contact us there anytime. Please reach out. I would also say that for anybody who hears this, whether it's them or whether it's somebody removed from them but they know of, please share our product with the folks that you know and yourselves, in the sense that this is a brand new tool. This is something that's fresh to market. Nobody else has it. Nobody else is offering it. It's a great risk mitigator. It will help the insurance industry in a big way, and certainly it will have an equal kind of justification within the hedge fund industry as far as helping them build in a new asset category. But I would also, if anyone in your audience is a startup person or thinking about starting their own business, I mean, now is the time to do it. It's a great time to be out there innovating new products, building new tools, new solutions, et cetera, because there's a big gap out there that I think there's been a lot of larger corporations kind of running the playing field. I think now is a really great time for the small business and small business minded person and entrepreneur to really start their own shingle and get something going. So I'm really excited about the future, but certainly very happy to be on your show, and thanks for having me.
Well, thanks so much. It's really been insightful. Always great to hear different perspectives. Thanks so much for joining us.
Likewise. Thank you. Take care.